Hey everyone, what's up and welcome back to Smart Dollar Resource. Make sure you hit that like button and subscribe to the channel if you haven't already, so you never miss out on any of our future videos about building your wealth. In today's video, we're diving deep into a book that's been a total game changer for me personally and for countless other investors. The Little Book That Still Beats the Market by Joel Greenblatt. We'll break down the key takeaways and I'll show you how to use them to make smarter investment decisions. Don't forget to check out the links in the description box for purchasing resources and supporting the channel. Alright, so The Little Book That Still Beats the Market. It sounds kind of cheesy, right? Like one of those infomercial products that promises to make you a millionaire overnight. But trust me, this book is different. It's actually super straightforward, easy to understand, and cuts through all the Wall Street jargon to give you a clear path to investing success. So, who's this Joel Greenblatt guy anyway? Well, he's not just some random dude who got lucky in the market. He's a hedge fund manager, a professor at Columbia Business School, and he's got a seriously impressive track record of beating the market for decades. He's not about risky bets or get-rich-quick schemes. Instead, he focuses on a value investing approach that's all about finding undervalued companies with strong fundamentals. And that's exactly what this book is all about, finding those hidden gems in the stock market. It's not about day trading or chasing the latest trends. It's about taking a long-term perspective, doing your research, and investing in businesses that are truly worth your money. Now, you might be wondering, okay, Graham, but how can this book actually help me? Well, let me tell you, this book is packed with valuable insights that can totally transform your approach to finance. First off, it helps you understand the basics of investing, like what are stocks, how does the market work, and what factors actually drive stock prices. Greenblatt explains all this stuff in a way that's easy to grasp, even if you're a complete beginner. But it goes way beyond the basics. This book teaches you how to think like a value investor. It's all about looking beyond the hype and focusing on the underlying fundamentals of a business. Things like earnings, profitability, and the company's ability to generate cash flow. These are the things that really matter in the long run, and Greenblatt gives you the tools to analyze them. The book also emphasizes the importance of patience and discipline in investing. It's not about chasing quick profits or trying to time the market. It's about building a solid portfolio of undervalued companies and holding them for the long haul. This approach can help you weather market fluctuations and achieve consistent returns over time. And here's the best part. Greenblatt actually provides a clear framework for finding those undervalued companies. He introduces his magic formula, which ranks companies based on two key metrics: return on capital and earnings yield. This formula helps you identify businesses that are both profitable and trading at a discount to their intrinsic value. But beyond the specific strategies, this book teaches you a valuable mindset. It encourages you to think critically, do your own research, and not just blindly follow the crowd. It empowers you to make informed investment decisions based on solid fundamentals, not fleeting trends or emotions. Alright, let's be real, no investment strategy is perfect, and Greenblatt's magic formula is no exception. So, let's break down some of the pros and cons of using this approach. On the plus side, the magic formula is incredibly simple and easy to understand. You don't need a PhD in finance to wrap your head around it. Greenblatt lays out the steps in a clear and concise way, making it accessible to anyone, regardless of their investment experience. Another big advantage is that it's a quantitative approach. You're not relying on subjective opinions or gut feelings. Instead, you're using concrete financial data to identify potentially undervalued companies. This takes a lot of the guesswork out of investing and helps you make more objective decisions. And historically, the magic formula has a proven track record of success. Greenblatt's backtests show that this strategy has consistently outperformed the market over long periods of time. Of course, past performance is no guarantee of future results, but it does provide a level of confidence in the approach. Now, for the downsides. One potential drawback is that the magic formula can sometimes lead you to invest in companies that seem, well, kind of boring. These aren't necessarily the flashy, high-growth tech companies that everyone's talking about. They might be solid, profitable businesses in industries that aren't exactly sexy. But remember, we're not looking for excitement here. We're looking for value. Another thing to keep in mind is that the magic formula is a mechanical approach. It doesn't take into account qualitative factors, like the quality of management, industry trends, or competitive landscapes. These are important considerations that you'll need to factor in when making your final investment decisions. And finally, like any investment strategy, the magic formula doesn't guarantee profits. There will be times when the market doesn't cooperate, and you might experience losses. However, by focusing on undervalued companies with strong fundamentals, you're increasing your odds of success over the long term. Alright, so you're probably wondering, Graham, how do I actually use this magic formula in my own investing? Well, let's dive into the practical application of this strategy. First off, you need to understand the two key metrics that drive the magic formula: return on capital and earnings yield. Return on capital measures how efficiently a company is using its capital to generate profits. A higher return on capital indicates a more efficient and profitable business. Earnings yield, on the other hand, tells you how much profit a company is generating relative to its stock price. A higher earnings yield suggests that you're getting more bang for your buck, so to speak. Now, to apply the magic formula, you need to rank companies based on these two metrics. You can find this data on financial websites like Yahoo Finance or Google Finance. Greenblatt recommends focusing on companies with a market cap of at least $50 million to ensure they have a certain level of liquidity. Once you've ranked the companies, you want to invest in those that score highly on both return on capital and earnings yield. Greenblatt suggests building a diversified portfolio of 20 to 30 stocks to spread your risk. Now, this is where your own research comes in. Don't just blindly invest in the companies that pop up on the list. Take the time to understand their businesses, analyze their financials, and assess their long-term prospects. Remember, the magic formula is just a starting point. It's a tool to help you identify potentially undervalued companies, but it's not a substitute for your own due diligence. And don't forget about the importance of patience and discipline. Value investing is a long-term game. It's about buying undervalued companies and holding them for years, allowing them to grow and compound your returns. All right, let's wrap things up with 5 key lessons from the little book that still beats the market that can totally change how you approach investing. Lesson number 1, investing doesn't have to be complicated. Greenblatt shows you that you don't need to be a Wall Street wizard to achieve success in the market. His magic formula provides a simple and effective framework that anyone can use. Lesson number 2, focus on value, not hype. Don't get caught up in the latest trends or hot stocks. Instead, look for companies that are undervalued by the market, but have strong fundamentals. These are the businesses that have the potential to generate significant returns over time. Lesson number 3, patience is key. Building wealth through investing takes time. Don't expect to get rich quick. Be patient, stay disciplined, and let your investments compound over the long term. Lesson number 4, don't be afraid to be different. The magic formula might lead you to invest in companies that aren't popular or well known. That's okay. Remember, we're looking for value, not popularity. And lesson number 5, always do your own research. The magic formula is a great starting point, but it's not a substitute for your own due diligence. Take the time to understand the companies you're investing in and make sure they align with your investment goals. That's it for today's video. I hope you found this deep dive into Joel Greenblatt's The Little Book That Still Beats the Market helpful. Remember to subscribe and hit that like button if you enjoyed it, and let me know your thoughts in the comments down below. If you want to take your investing to the next level, be sure to check out the links in the description. I've included links to the book itself, as well as a fantastic broker app that you can use to start putting these strategies into practice. As a bonus, if you sign up using my link, you'll even have a chance to win an Apple stock and get up to 10 free shares. It's called MooMoo, and it's what I personally use for all my trading. Make sure to explore other videos on this channel for more tips and tricks on how to manage your money, make smarter investments, and build a solid financial future. Thanks for watching, and I'll catch you in the next one.